Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
In 2026. This article was written by The Asian Investor. Summary. SoFi Technologies (SoFi) delivered record customer acquisition and exceeded both revenue and earnings estimates in Q4, reinforcing my strong buy rating. SoFi's financial services segment drove 158% year-over-year segment earnings growth in FY 2025. Lending saw record originations of $10.5 billion in the fourth quarter, up 46% year-over-year. Guidance for FY 2026 implies 30% adjusted net revenue growth and 52% adjusted EBITDA growth, positioning SoFi for continued rapid earnings growth. Despite a premium valuation, SoFi's unique customer growth momentum and profitability profile support at least 36% upside potential to a $30 share fair value. SoFi Technologies (SoFi) reported stronger than expected earnings for its fourth fiscal quarter on Friday, driven by rapid expansion in the financial services segment and overall positive trends in customer growth. The fintech added more than 1 million new customers to its SoFi-branded personal finance ecosystem in Q4 25, which was the most successful quarter in terms of customer acquisition in the company's history. SoFi ended the 2025 fiscal year with a total customer count of 13.7 million in its portfolio, which exceeded my high-case October estimate of 13.5 million by 200K. I like that SoFi continues to maintain high growth rates in its core business, and the fintech is seeing rapid expansion of its profitability as well. Further, with rate cuts likely to occur in 2026, SoFi also has a catalyst in its lending segment this year. Originations are soaring, and personal loans provide a big opportunity for the fintech to grow the profitability of its lending segment. Shares are not too expensive given the strength of the firm's underlying growth, and I confirm my strong buy rating following the Q4 25 earnings report. Previous rating: I rated shares of SoFi a strong buy in my last work. Profit boom makes SoFi a strong buy, chiefly because of the fintech's strong customer acquisition growth, which continued unabated in the last quarter. SoFi exceeded even my most optimistic estimate for customer acquisition in Q4 and made massive progress in terms of improving its profitability profile in FY 2025. This growth was chiefly driven by financial services, although lending is also seeing strong growth dynamics. SoFi's outlook for FY 2026 calls for 30% year-over-year growth in revenues, setting the fintech up for a massive escalation of its profitability this year as well. SoFi crushed estimates amid FS momentum. SoFi reported better than expected earnings on both the bottom and the top line for the fourth fiscal quarter. The fintech generated 12 cents per share in normalized earnings, compared to a consensus estimate of 11 cents per share. SoFi also beat on revenues and exceeded the average prediction by $30.5 million. SoFi benefited from a continual migration of customer accounts from financial institutions towards community-oriented digital personal brands in the fourth quarter. As a result of this migration trend, SoFi added more than 1 million new members to its financial ecosystem in the fourth quarter. The platform had a total of 13.65 million customers using its products as of the end of FY 2025. Which implies the addition of 336K new customer accounts on average per month in the fourth quarter and a monthly acquisition rate of approximately 294K throughout the last fiscal year. In total, SoFi acquired a total of 3.5 million new customers in 2025. While SoFi does not submit account or member guidance on either a quarterly or yearly basis, I believe that the migration and customer growth trend indicates that the fintech will be set for a strong FY 2026. Assuming a moderate growth rate of 30% in terms of customer acquisition, a conservative assumption, given its 35% year-over-year growth in FY 2025, the fintech could be on track to have 17.7 million or more customers by the end of the current fiscal year. Financial services, once again, was the main driver of SoFi's EBITDA and earnings growth in the last quarter. SoFi's financial services products are highly profitable, and therefore selling an FS product to a customer is significantly more profitable for the fintech than a lending product. As a result, the financial services segment is seeing an explosion in profitability. The FS business, which is selling mainly fee-based products, generated $793 million in contribution profit, with equal segment profit in FY 2025, showing an increase of 158% year-over-year. While financial services is highly profitable, lending is also seeing improving results, mainly due to an increase in new loan originations across SoFi's entire loan stack: personal loans, student loans, and home loans. Lending on a total contribution profit basis is overall the most profitable segment for the personal finance company. SoFi generated $1.0 billion in lending segment profit in FY 2025, plus 14% year-over-year, with record originations boosting the segment's overall performance. In total, SoFi completed $10.5 billion in originations in the fourth quarter, plus 46% year-over-year, with personal loan originations dominating the mix. In the fourth quarter, SoFi originated 43% more loans in the personal loan category than in the year-earlier period, which is by far the biggest and most profitable segment for SoFi's lending operations here. The fintech reached a total quarterly origination volume of $7.5 billion. Nearly 71% of all Q4 25 originations were personal loans. While FS has captured investors' imaginations and hopes for a drastic earnings ramp, lending especially is an interesting segment for SoFi in a falling rate environment. Although the Federal Reserve did not lower federal fund rates at the end of January, it last lowered interest rates by 25 basis points in December. The odds are in favor of more rate cuts in 2026, which could make lending products more attractive for a whole range of borrowers, including people that want to refinance a mortgage or other debt. Therefore, falling interest rates could be a significant catalyst for loan origination growth across the loan stack for SoFi in 2026, especially with inflation no longer being a major risk for consumers or investors. SoFi's guidance for fiscal year 2026 implies strong growth upside. The fintech guided for $4.65 billion in adjusted net revenue for the current fiscal year, which implies a 30% growth rate year-over-year. Additionally, the fintech platform sees $1.6 billion in adjusted EBITDA, which calculates to a growth rate of 52% year-over-year. For comparison, SoFi's full-year EBITDA in fiscal year 2025 increased 58% year-over-year. The outlook indicates that management believes it can sustain its member growth while simultaneously growing its EBITDA by more than half year-over-year. SoFi's valuation versus fintech rivals. SoFi's shares are currently valued at a forward price-to-earnings PE ratio based off of FY 2027 earnings of 29.7x, which is about 36% above the fintech's 3-year average PE ratio. While SoFi is one of the more expensive fintechs to buy, the platform has unique growth and profitability characteristics. The industry group in the fintech sector includes Upstart, UPST, which is seeing by far the fastest growth. The consensus long-term EPS growth projection calls for 168% annual earnings growth going forward. BNPL powerhouse Affirm, AFRM, New Holdings, NU, and Block, XYZ. Upstart is also a credit-focused lending startup that helps financial institutions and credit unions to originate more loans through the utilization of AI. Upstart is also set for a growth acceleration with lower interest rates, which may spur credit demand, strong platform growth, high margins, cheap PE. In my last work on SoFi, I calculated a fair value for the fintech platform in the neighborhood of at least $30 per share, based off of a fair value PE ratio of approximately 47x, which gives the company at least 36% upside revaluation potential in 2026. I still maintain this stock price target for SoFi, as the fintech is executing well in FS, has customer acquisition momentum, and the lending segment could see a catalyst from lower federal fund rates in 2026, potentially stimulating credit demand and new personal loan originations. Risks with SoFi. The biggest risk for SoFi relates to the fintech losing momentum in its financial services segment due to growing competition in the personal finance market. Lower growth for new investment and insurance products could offset SoFi's growth in lending, which I expect to be material in FY 2026, plus 20% year over year. What would get me to change my opinion on SoFi is if the fintech platform were to lose momentum in terms of customer acquisition or if it saw an EBITDA margin contraction. Final thoughts. SoFi delivered strong growth in the fourth quarter, which is typically a strong quarter for fintechs as they benefit from seasonally higher consumer spending and increased loan originations. SoFi's customer acquisition is nothing short of impressive, and Q4 achievements in this regard indicate that the fintech platform is entering 2026 on a very strong note. SoFi's financial services products will remain key to the company's expansion in 2026, although I also see catalysts for loan growth in the core lending business in a lower rate environment as well. Shares of SoFi are expensive relative to other fintech plays, but SoFi has fantastic growth and is expected to grow much faster than most other fintechs. In fact, only Upstart is projected to achieve higher growth than SoFi in the near future, although both companies are set to benefit from lower federal fund rates. SoFi is the ultimate growth play in the fintech market, in my opinion.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.